Alright, so in this video, we're going to talk about what inducement is and how to spot it in the market. Inducement has a lot of similarities to what liquidity is and vice versa. Okay, liquidity looks like inducement and inducement looks like liquidity. But we're going to break it down in this video and show you and explain to you what inducement is. So inducement is an area where people like to get involved in the market, buying or selling. Generally, the majority of retail traders that like trading double tops and double bottoms. Okay, inducement creates liquidity. So, in this explanation here, inducement looks like something like this: when price is going up, like this, and then price retraces, right, and then shoots right back up. All right, we know as smart money concept traders that price was never able to come to an area of demand. Okay, when price shoots up, there was an area of interest where buyers and or retail traders, about 99% of the traders that trade, buy off of some sort of indication that they think this area is a true buy in the market, right? But then the market retraces all the way back to come back to the area of demand, taking out the retail traders, these retail trader buyers, right? And what happens is the market takes them out, and then price starts to continue in that direction. Okay, so inducement is something where an area where buyers, in this case, since price is an uptrend, where buyers have bought way too early in the game, right? And that's just one formation of what inducement looks like. But inducement can also look like when we're going on a downtrend. Obviously, when price does this, extends, retraces, and then pulls back, and then retraces all the way back to an area of supply, and the inducement was just right above the supply level here, okay? And then it taps supply, and then it continues to the downward trend like this, okay? So that's what inducement is. Inducement is just an area where people like to get involved heavily in the markets, like pretty much about 99% of the traders. Inducement can also look like in the forms of double tops. Okay, something like this, or double bottoms. It can also look like your, fairly double bottom that looks like this, and a fairly double top that looks something similar to this, right? Where price is just like this. Okay, inducement can also look like in the form of liquidity when price is trending, to the upside like this, right? And liquidity is being formed. And all this area here, it's a trend. This is a trendline liquidity, right? And all this area is just inducing. It's inducement for people to continue buying just because they see an area of where a repeated buying or selling is happening in the markets. Prices then come and take out all this liquidity, only to figure out that price is hitting an area of demand for prices to continue to the upward direction. So all this idea here, the action by the banks is essentially inducing traders, like buyers in this case, to buy early in the market before the market takes them out, right? So the market essentially creates all this inducement for the buyers, and then after this whole formation has finished, then we call this liquidity. This is liquidity. Liquidity are orders that are underneath that retail traders are buying from, right? They're buying from each level that they're seeing, and liquidity is right below. It's their orders, right? They're buying orders. So liquidity is essentially they're buying orders that the banks are taking out to then use that money and fuel up to the next move, to the upside. Okay? So once again, inducement is just an area where people heavily get involved in buying, which essentially is your 99% of the retail traders in the market who buy and sell way too early or way too late. All right? Out of fear, out of greed. So liquidity is a point. So what is liquidity, right? Liquidity is a point in the markets where retail traders get taken out. All right, just like this scenario, let's just use the trend, the trend line liquidity right here, okay? When prices are buying, everyone's buying here, right? And then here everyone is selling. So essentially, liquidity, right, is again just an area where prices, where people are buying, they're seeing a pattern like this, and then liquidity is taken out from both buyers and sellers, right? Essentially. So this would be a downtrend, okay? And then this would probably be an uptrend going this way, taking out everyone from this side, okay? So liquidity, again, is a point where all the retailers get taken out. That's the action part, okay? Because, again, liquidity are just orders where people have set their stop losses here below and stop losses above, where people are selling, 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 right? Here people are buying, buying, and buying, and buying, all right? That's liquidity, okay? So that's the two differences between liquidity and inducement, okay? Very easy and very simple to understand. You don't want to mix these two up because you can get very mixed up into them, obviously. If you don't know where liquidity is, you are probably that liquidity. You're going to start creating inducement for liquidity to create for the markets to come and take you out, for the banks and institutions to come and take you out, okay? So when buying from demand, there will be inducement, right? And vice versa, from supply, there will be inducement in between. So this is what I'm talking about. When you're buying from demand, right, in this scenario that I explained, this is inducement because price never touched our area of demand here, right there. So we would wait for price to come back, take out that inducement, which is in a form of liquidity now, because there's stop losses right below, and then prices will continue back in the upward direction, right? Same thing goes for the sellers. When prices are going down, people are selling way too early, prices go back, retrace back like this to an area of supply, and then we look for the sellers to be taken out here, the ones that sold way too early. In the sense, this is inducement. In a sense, it's also liquidity, also because prices come out and take out this area where all the stop losses were up here. Okay, we had literally money sitting right at these two areas here. Oops, that's way too big. Like that. Okay, and then we had money right here. Okay, and the bank's jobs, institutions' jobs, are to take you out. Inducement essentially is an area, again, where banks and institutions are teasing you into thinking you should buy early or you should sell early, or sell late and buy late. Okay, they're just teasing you in the market. And we know the way markets move, they move based off of supply and demand. So if we can understand that concept, we can understand that buying too early and selling too early is essentially an area where we're being teased into buying too early and selling too late. Okay, for the banks and for the institutions to come and take you out eventually. Okay, if you aren't smart enough in terms of how to get out of the trade way too early, right? So that's what it is. So let's go to the next. So it's above demand and below supply zone, right? What we just showed you over here. When entering any trade, let's talk about the uptrend in this case, right? Okay, when entering, wait before entering, right? You don't want to rush into anything that's way too early, like this. You want to wait prices to retrace all the way back to an area of demand, right? Could be here, probably, maybe take out some of this inducement, push back like this, come all the way back to an area of demand like this. Okay? You want to wait for when prices retrace all the way to demand before entering. That's just a key in the market that we understand as supply and demand traders. Okay? You can see there's more inducement happening here. People try to buy because they saw a double bottom, a potential bottom here, creating another double bottom, so more inducement happened in the market. So in a sense, this is inducement, where prices were taken out, buyers were taken out, they were buying way too early in the game. Prices came in, mitigated this demand area for only to find that prices were actually bullish from here to take prices up. Okay, inducement is the area where people are interested in buying way too early or way too late. It's a trick in the market, right? And then liquidity is the action where people have bought already and have placed their stop losses right below for the markets to only come and take them out. Very easy, very easy to understand. Same thing goes for the sellers. Again, I know this is a bit repetitive, but it's something that we need to address all the time here when this is happening, right? So something like this. Okay, then we have an area where people supply is coming here, where a lot of sellers sold here and here, and now we call this inducement. And then when price is taken out, this area of two sellers, right, two sell sides here, and then we call this liquidity now, because there's a lot of stop losses right above supply, and then prices goes back in the intended direction. Okay, so you need to wait before entering. Okay, a lot of this is just waiting patiently before before the inducement is taken out. Okay, you can also call it liquidity because it is essentially liquidity at the end of the day, right? But liquidity doesn't happen yet until there's multiple areas where people are buying. Okay, it can also inducement can also just be one single buying area, like this, for example, right? If this area wasn't here, price could just come here, right? Tap the demand and push right above. The single V-shaped formation here could just be its own inducement as well. Okay, because we can see inducements in various formations. You can see it in a V-shaped form buying, right? A V-shaped form selling. We can see it in double bottoms, as we explained. Double bottoms, tops, right? A slight double bottom, like this, right? A slight double top, something like that, right? It can look like this anywhere and anytime, right? It can also look like in a very, in a trend line formation as well. Multiple buying, multiple selling happening. This is all inducement for buyers, obviously. Trend line liquidity, right? Before the buyers are taken out, then we see that sellers are taken out, and then price just goes back into the intended direction. All this was inducement and then created liquidity, okay? So why does inducement happen, right? I mean, inducement happens only for the banks and institutions to take you out. Inducement happens to create liquidity in the market. In order for the market to move, we need liquidity to form in the market. Okay, once again, let me explain this. Inducement happens because it's an area where 99% of the people are buying and or selling way too early or way too late. And in order for that to happen, once inducement happens, liquidity will be creating right after inducement. Okay, once liquidity is created, we need the markets to come to the liquidity to take out that liquidity in order for the markets to continue moving. Okay, we're using that liquidity. We're using the 99% retail traders' liquidity to fuel the next move to the upside or to fuel the next move to the downside. It's very important to know which one comes first, which one comes second, right? Inducement comes first, liquidity comes second. All right? Make sure you put that in your head so you understand this, okay? So the psychology behind inducement, again, just what I explained, okay? Very easy to understand because liquidity needs to be formed for the inducement, okay? Inducement has to create for the liquidity's purpose, and then the banks will come out and take you out, okay? That's the bank's job. That's what they're looking for, is to trick you into these areas to buy way too early, way too late in order to be taken out, okay? And as I mentioned, it is a form of liquidity. So that's it, right? So let's go down to a chart here to show you what it looks like roughly in a diagram here that we took out, that we drew, okay? So as you can see here, prices are pushing up, right? And then prices retraced. Once you see prices retraced, you can see there's a lot of buyers and sellers that are happening here, right? In this area, in this formation of liquidity, in the retracement, you can see there were sellers that tried to sell too early. Prices went and take them out right there, okay? And then prices sold off, okay? So in a sense, This is inducement and liquidity, right? But inducement had to happen first before the liquidity was taken, okay? So prices were going down like this. As you can see, someone saw that there's one top, then there was another top that had to be sold off from. And then prices are like, banks are like, we're going to take you out. Now that, taking the stop losses right above here is called liquidity, right? Stop losses are liquidity for the banks to fuel the next move, to go down. Okay? So you're being tricked into all of this, obviously. It's a good reason for the banks to do this, right? You can also see it here too, which I didn't specify here, but this is also inducement as well. Right here. This is, slight double tops, right? And there we go. Oops. Excuse me. There we go. Okay. You can see another top, second top, people try to sell. This is inducement in the markets. And then it created liquidity because people have sold twice here. Traders, retail traders, obviously. Prices taken out this inducement, and now in liquidity, and now prices retrace. Notice what's happening here. We have more inducement in a V-shaped formation, right? Right there. Inducement. Okay? Now, why is that inducement? Well, because prices never touched our area of demand. Right here, where this blue demand zone is, right? It never touched it. So prices shot up. And once the price shot up, price came down, you have people, retail traders, interested in buying here because why? There's double bottoms now forming. So now, this is inducement, prices shot up. Now we have inducement here that's shaped in liquidity. Because why? Because we have a lot of stop losses right below and this low as well. Now, the bank's interest is to come back down and take you out. Sure enough, you can see this area that retraced, took all these buyers out. Whoever tried to buy here way too early in the game, right? We smart money constant traders are smart enough to understand where to buy and where to sell, from demand and supply, from supply and demand only. Don't buy too early, don't buy too late in the game, obviously. Now, here you can see more inducement. When people are trying to sell, when retail traders are trying to sell, you can see, well, there's more inducement there, right? Because people sold, retail traders sold. There's more here. This is the trend line liquidity. Here's the double bottom or what have you type of liquidity here, right? More inducement in here because people try to buy, and they got taken out. People are buying way too late or way too early in the game, right? People buying way too early, and then people are selling way too early in the game. Once we figure out, prices just came to the demand level and took out everybody. Took out these people, these people, these people, and these people. It's a game of manipulation at the end of the day, okay? So always remember that when you see inducement, when the price hasn't reached your area of demand, in this case, don't sell or don't buy too early, right? You don't want to buy off the first move that price is showing you. You want to wait patiently for price to form, wait for all that manipulation to happen, in the market, whether it's double bottoms, triple tops, V-shaped formations, anything that involves trend lines like this and like this. Wait for all that to be taken out, and then we wait for the true move to the upside, okay, with the exception of a change of character, okay, something like, maybe like this, right? Change of character. And then we looked for the buys to the upside to take everyone out. It's simple to understand if you just keep it very simple, right? So this was the bullish example. Let's go to the bearish example. Let's see this a bit. All right. So here we're going on a bearish move, right? Market is bearish here. You can see on the major structure, price is retracing. While it's retracing, it broke structure here, and it's retracing all the way to the upside here. While it's retracing, people are either buying way too early, right? People are buying way too early, creating inducement here. There's more inducement here, actually, and here as well, okay? and also here and here, everywhere, right? But the true move that we're really looking for is when price pushes back to supply. You can see how there's a V formation right there that was inducing people to sell too early. People sold way too early, then price retraced all the way back up just to take these people out, the traders, right? Then we can see people sold here once, people sold here twice because they've probably found a trend line, a trend line formation for them in order to look for sells, maybe expanding their trend line like this, waiting for price to come here and sell off again, right? And only to see that price took them out. It's inducement. And then took out their liquidity, took out their stop losses, took that money and used that money to fuel up the next move. Now once that price started to push down, it created more inducement here. All right, there's stop losses here, here, and here now. And the market just comes down and takes everyone out here and here. Whoever bought at those areas. And prices just continue expanding to the downside. Okay. The real importance of this is to really understand, do you want a quality trade or do you want an inequality trade? A trade that won't perform well? Or do you want to potentially, obviously nobody is in the markets to lose money, right? So that's the real question is, do you want a quality trade or a bad quality trade? If you really want a bad quality trade, then you should, and you're buying and selling amongst everybody that's doing the same thing in here, right? But if you're just patient and waiting for price to get back to your supply level and wait till it touches and wait for all those liquidity to be taken out and all that inducement to complete forming, right? Then we wait specifically for that change of character, right, in the market. And then we wait for that complete sell-off right there, right? It's so easy to spot. If you look at this area, you can see prices were retracing. Prices broke below, retraced, broke below. You can see here we had some sort of inducement as well. We had a V formation inducement, right? And we had some trend line right there. More inducement, more buying orders that happened here. And you can see prices took everyone out here, right? Price retraced all the way back deep into a supply area before prices started to push to the bear side, right? You can see we had a clear change of character here, and this is where your complete sell would have been right there, right, to the downside. Once the banks did their job, you can see more inducement on the pullback, right, because you thought there were retail traders that thought that this was an area where people were ready to sell. Okay, they saw an area, potential area of a trend line here, right, to look for a sell, but instead got tricked out and then had stop losses right above this high here for the markets to do their job and take out the liquidity, only to use their money and the liquidity to fuel the next move. It's very simple once you understand the concept of liquidity and inducement. So I hope in this video you did understand what inducement and liquidity are. All right, very, very simple to use. Just make it so simple in your head, because once you spot inducement in the markets, you can then just be more of a patient trader. You can encourage yourself as a trader to be more patient, because you know that this inducement, where whenever anyone buys first or sells first, you always want to be weary and careful about that, because they're getting some sort of indication, those buyers and sellers are getting some sort of indication in the market that they should be buying and selling right away. Well, you know, as a patient trader, to wait for prices to get to your area of supply, okay? And in this case also an area of demand. We know where we should be buying and selling. So why not be a patient trader and stick to your rules? Do not buy first. If you buy first, you'll lose. Okay, do not sell first. If you sell first, you lose, right? Very simple to understand. If the markets had broken right above a new high, then so be it. We can readjust and then look for potential new areas for the markets to re-enter, right? If prices broke above a high, we can wait for price to get back to an area of demand like this, right? And then there's more inducement right underneath. Then we can look for potential areas to buy from this way, right? Something like that. Or if not, right, price could probably create more inducement like this, only to find out that price should get back to this demand area for people to buy, right? I encourage you, if you don't know if you don't know if that area is a inducement area, I encourage you to look at that specific area where prices are retracing back to an area of, supply of demand. Let's say in this case right here, if you thought this was an area of where price was supposed to go up from here, right? And this is the higher time frame. If you're choosing this to be like, let's say this is the daily time frame, and you drop down to your 1 hour down here, or 50-minute, you can see if there's potential entries in the lower time frame, okay? And if there isn't, then you shouldn't be buying anything here, even if prices move aggressively to the upside, right? You shouldn't be chasing it, because most likely this is probably just creating inducement for the markets to come and take out if you don't have any entries on the lower time frame down here, right? So then you shouldn't be you shouldn't go and try and look and find for more entries just because you haven't made a trade just yet, right? All you need to keep in focus is that our demand hasn't been touched, so we need to be waiting patiently for it no matter what, right? Same thing goes for the sells, right? If the sells haven't happened yet, don't start chasing the trades, each inducement just because, it's time for you to look to sell, right? Because your clock is done and you need to be looking to sell right away. You don't need to chase anything, right? Be patient. All right, so I encourage you to go in your charts, obviously, and go and look and mark out your inducement areas. After this video, we're going to go straight into the live chart to show you a live chart example. All right, until then, we'll see you soon.